Hey guys, in this video, I'm going to explain the one tool that you can use as an investor to identify when a market is overvalued or undervalued. One way of looking at the market that helps you to see if something is expensive or cheap, whether you should buy now or whether you should wait for a better price to take place soon. I'm talking about one tool, one indicator, and one decision that you need to make. So let's get into it.
So what is this tool or this indicator that we're going to be using that's going to help us to identify whether something is overvalued or undervalued? Well, it's a very simple tool and you can see it on my chart here. It's actually called a moving average. Now, what a moving average is, it's an average of the last 50, 100, 200 periods. So if we're using a daily chart, it's an average of price of the last 50 days or the last 100 days, the last 200 days, depending on what setting you use. Why is that useful? The reason the moving average is useful is because you can very quickly see whether a price is trading above its long-term average or below its long-term average. And therefore we can use that to understand whether something is overvalued or undervalued. So I'm going to give examples of how to use this, but it's a very powerful tool. And the important thing is this: institutions use moving averages a lot to identify when prices come to a price point where they think it's undervalued enough to buy. Also, when it's way above the moving averages, it's a massive distance away from it. That's when they start to get nervous and either take profits or wait on the sidelines to wait for a pullback. All right. So I'm going to explain all of those in a second. Now, on my chart here, we can see three lines. We've got the red line, the blue line, and the green line. The red line is a 50 period moving average. The blue is a 100 period moving average, and the green is a 200 period moving average. These three are the best moving averages to use. There are others you can use, like a 10, 20 for shorter movement, but these are the key ones from an investing point of view, especially if you're looking to hold on to something for like a year, 3 years, 5 years, 10 years. These are the moving averages to use. Pension funds use these, institutions use these, hedge funds, they'll use the 50 and the 200 primarily. The way they look at things is if price is above its 50 moving averages, 50 moving average, it's in an uptrend, and therefore they'd look to buy when price pulls back to the moving average. If it's above the 200 moving average, this is called the long-term trend. The long-term trend is up. So here's a chart of Nvidia just as an example, and we can see here more or less since inception, since say 2016 or so, it's been in a bullish trend, right? It's been above the 50 moving average, the 100 and 200. So when these go up steeply like this, it tells us there's a strong upward trend, right? So the price is above the moving average. Now just think of that for a second. If price is trading above its long-term moving average or the long-term average of its price, that means it's pretty strong. The trend is up, therefore we can look for buying opportunities. If it trades below its long-term average, and I'm going to show you examples of that. So in fact, an example would be something like MicroStrategy, where it's breaking down. If I look at a lower time frame, you can see here it's broken below both the 50, the 100, and below the 200. But to keep it simple, we're going to use the monthly chart, and what we're going to look at is examples of uptrends and downtrends. So let's start with the first one, which is Apple, right? Apple is, you can see here, it's clearly in an uptrend. Price is above the 50 moving average and the 100 and the 200. So how is this useful to us? The thing to observe is this: every time it goes above the moving average, if it goes too far above it, it becomes overextended. So this is how you identify whether something is overvalued. If you notice here, every time it pops up, it always comes back to the moving average sooner or later. It did it once here in 2016, a second time in 2018, a third time in 2025, and now we wait for a fourth time for that to happen. So this represents excellent buy-in opportunities. If price pulls back to the moving average, what happens is a lot of institutions then will trigger buy orders at this moment in time. There are lots of algos which are set to just buy as soon as price comes back to the moving average automatically. That's why this isn't a coincidence. The fact that it bounces off the moving average is not a coincidence. It's programmed that way. Why? Because as human beings, we need to have an easy way to make a decision whether something is undervalued or overvalued, whether we should be buying something now or whether it's sitting on the sidelines. And the moving averages are a fantastic way of achieving that. Okay, so Apple here, we can see the move is up, it pulls back to the 50 moving average. Now we can see here we're significantly above the moving average at the moment. We're overextended. That means we're so far from the moving average that it's quite risky to be buying at these places. Therefore, the sensible thing to do would be for us to wait for this to pull back to the 50 moving average, which is around sort of 205, but maybe $210 by the time this comes back down. So if we look at this, we're roughly around 290, 295. We're looking for a 33% drop before we deem it as being at a good price to buy, as before we say it's excellent value. Just think of it like this. We're looking for a discount, right? We're looking for a big discount on these stocks. We want to buy them because they're household names. They've got a track record of success that isn't going to change. However, right now they're overvalued for what they actually do. So we're looking for them to come back to a sensible valuation so we can buy. So just treat this like you're looking and waiting for a discount, right? So treat this like your favorite store, right? Your iPhone, your clothing store, whatever branded goods you go to. If they're having a 50% discount, that's the time when you buy. That's why people wait for Cyber Monday, they wait for Black Friday, they wait for Christmas sales, Boxing Day sales, New Year sales, summer sales, because items get discounted and that's when we buy. Okay, so the same thing with stocks. But what helps us identify when they're at a discount are these beautiful lines called moving averages. The simplest tool in investing or trading is often the most powerful. Okay, so this is no exception. So that's Apple. So what we're waiting for this is to head back down. Let's look at some other examples. Look at it. This is Google. This is the 50 period moving average here in red, and you can see price has been above it for quite some time, and then pulls back. This was in 2022. This was in 2020. Now, funny enough, look, during the time of COVID, what happened? Price dropped all the way to where? The 50 period moving average. And then what happened? It turned around from that. Why? Because algos are, at this moment in time, buying heavily. When this happens, algos kick in from the pension funds, investment funds, etc. So that was a buying opportunity. Then in 2022, 2023, end of 22 to 2023, you can see that the reversal took place from this 50 period moving average. It came all the way here, acted as support, and pushed price back up. And here we came very close to touching it in 2025. And now we are way above it. Okay, so what are we going to do here? Simple. We're going to wait for a drop to this moving average, which is going to be around $175, $180. Yes, it's before you ask the obvious question, that's going to be a big enough drop. Can we get that magnitude of a drop sometime this year, next year? Yes, at some point, price always goes back to the moving average. One or two things happen. This moving average, remember, it keeps going up the longer price stays here. But at the same time, price also can move sideways and start to drop. So they meet somewhere in the middle. So by the time they meet, this moving average might be up here. It might be at 220. It might be at 240. But what we know is regardless of what price it's at, it represents a discount for us to buy. Okay, let's look at others. Nvidia, look, again, look how massively this is above its long-term moving averages. Again, the last time we had in 2022, look at this. This was at $12. Nvidia was $12 in 2022. Where did it turn from? The moving average. Look at this. We came close to, where did we turn? Almost touched the moving average. This touched the moving average, so that was a buy. We're waiting for the same thing here. If this drops to around sort of $100, $110, then that'll be a buying opportunity. Okay. Let's look through Tesla. Now here's an example of one where you can see Tesla, a good example, is not as clean as the others. Like if we look at Nvidia, you can see it's clean in terms of its interaction and the movement. Tesla's a bit more choppy. We can see price moves up, comes back down, bounces, okay, goes through the 50 moving average, but look, it doesn't stay too long. It goes above it, comes back above, goes below it, doesn't stay for too long before reversing sharply. Here, look, it bounces off it immediately. And therefore you can look for another opportunity to buy if price gets around to a sort of 280 level. This is a fantastic tool, I kid you not, and something that you should be using. Another example, AMD, price comes back to the 50. Let's say you buy it as soon as price closes. Now, question is, do you buy as soon as price touches it or as soon as it closes below it? It doesn't matter, but what I'd say on the safe side is wait for a close, for the monthly candle to close, either touching the moving average or below the moving average, and that represents a buy, right? It means that you've got less to think about. You just need to look at what happens at the end of the month and then make your buying decision there. It's much simpler. You can buy as soon as it touches the moving average. You can. I would just prefer to wait for the close because it's one less thing to think about. We turn from here, it goes up. Then next month, a few years later, it comes to here. You can see a 50 moving average. This is what $115. Touched it. It went straight through. So we had a bit of a drawdown before going back up. But here's the difference. And this is the important point. You have to decide where you're going to buy. You're never going to nail the bottom or nail the top. It's never going to happen. But what you can do is identify a place where it's valuable to enter. So let me just draw a line here, right? Let's say we bought here, okay, where the back line is. Just think about that for a second. You could have bought, some people would have bought up here. Some people might have bought as soon as it closed above this previous high here, thinking, okay, we're going to high heaven. It goes up, fantastic, they're making money, and then it drops all the way back down. At what point do you decide where to buy? You can either use support resistance, or you could just move an average. That's the beauty of it. So here you would buy at a price where it's reasonable, $115. Yes, it goes against you for a few months, but then it recovers beautifully. And that's the great thing about the moving averages. Price doesn't go too far below them before turning around. The caveat is you must choose a trending stock, something that has an upward bias. Hence, it's got to be a quality company or an index. Let's look at the index. Let's look at US 500 or SPX, my favorite one. And you can see here, this is where this is the best example actually, because we can see this was sort of the .com where it went sideways for a while. And from the credit crunch here, market regime changed, money printing, market started accelerating upwards. So since then, what we see is every time it comes close to the moving average, the 50 moving average, it goes up once. This was in 2016, a second time, 2018, third time in 2020, fourth time in 2022, fifth time in 2025. Now this close didn't touch it, it came very close. But what I'm showing you is it's not a coincidence. Look at how every time it gets to the moving average, it bounces off it, it's rejected off it. And that's exactly what we expect to happen. So if price comes all the way back down to here, 5,300, 5,500, that is a buy. It's not unrealistic. We're talking about, a 20, 25%, 30% correction. That happens. Not very frequently, but it happens enough. Look, it happened here. We had a big drop here. We had a big drop here. This was in 2020. So in the last 6 years, we've had 1, 2, 3 major corrections. So it's not unreasonable to expect a fourth one to come at some point, okay? So that demonstrates it. Now, let's look at some other examples or recent examples that I think are worth keeping an eye on. So we've got S&P 500. That's got a big drop to do. So that's not going to happen for a while. This is NASDAQ. Again, you can see here, look at the interaction with the 50 moving average once, twice, 3 times. We're expecting a pullback and we'd buy there. All right. Let's look at some of these others. So this is Ulta Beauty. This is just a choppier chart, but I wanted to show you different examples so we're not just looking at picture perfect. So do we have an uptrend? Yes, we do. Great. Secondly, it pulls the moving average, we'd buy it. Let's say we buy every time it pulls back once and then twice here. Okay, now this time it went against you by a fair bit. So you would have been panicking at this point for like almost 2 years, from August 2019. It took November 2020, but not too bad. About a year, just over a year and a few months before you recovered. It's not the end of the world, right? You just sit tight and then you're rewarded. So you bought here at 235, it went, doubled. Great. So then second opportunity here, look, it came down to 386. There was a buy opportunity here. Okay. We see prices touch the 50 moving average. We buy. And then what happens? It goes against us for a fair bit, but then starts to shoot up, down, and eventually rockets. So yes, you're not going to get the bottom, but you're getting close to the bottom. Now here's one other thing. Now, by the way, look where it is today. So based on what I said, this is at 460. That's a buy today. Now, what happens if it goes below the 50 moving average? Well, check this out. You've got the 100 period moving average. Look, that also acts as support. If price slices through it, let's say you buy here, you can buy again once it goes to the 100 period moving average and dollar cost average into it. So let's say you bought here, okay, this stock, this investment or trade is in a minus, but then if you buy here, within a year, you've recovered the profits from here and you're back to break even and you get a significant return. Second time it happens, you buy here, okay, you're in a bit of water, it goes against you. You buy again here, you've dollar cost average into this, it goes up nicely. So the same thing here is come to this point at 460. You can buy at this level, and if it drops down to the 100 period moving average, you'd buy there, wait for it to turn around and dollar cost average. Okay. Microsoft, look at this. This 2022, we pulled back to the 50 period moving average. It jumped off it. It came close to it in 2025, bounced off it again. Here we are today. Okay, it's in 2026, March just gone. It bounced off this. Now it's back at that point, right? So this is a buy regardless. So you could buy here around what this is a 375, call it 375. Let's say it goes down to the 100 period moving average. That's another opportunity to buy, because at some point we know this has to go up. Why? Because Microsoft is a household name. They've got massive cash reserves in the bank. They're still relevant. Their products and services are still used. It's just they've got a heavy exposure to AI, which at the moment is feeling a bit overvalued or overinflated. Okay, so that's Microsoft. Next one, T-Mobile. Look at this. Beautiful uptrend. Price comes back down, comes bouncing on this in 2020. Where did it turn from? The 50 period moving average. What about in 2015? It turned off the 50 period moving average. And in 2023, it came close to it. And look where we are right now. It's off the 50 period moving average. This is a buy with the expectation of it going back up. All right. And so on and so forth. We've got Netflix. This one's another good one. Why? Because it shows you what happens when it slices through and how to dollar cost average into this. I saw this in 2022 around here at $41. And this was a good buy. But look, if you bought here, it would have gone against you by at least 50%. So you'd have lost half of your investment. But let's say you bought here. Then you buy again here. Why? Because it's gone into the 100 period moving average. Then from here, this is almost near the lows. Then from that moment onwards, it just continued to recover, giving you a huge return all the way back up. This is massive. You're talking hundreds of percents of return. And today, where are we? We're close to the 50 period moving average. So when it comes down, that's a good buying opportunity. If it slips through, then that's another buying opportunity on the expectation of it turning around. Okay. So that gives you an idea of how to do it. I'm going to put a few more examples here. This is bookingholdings.com. See, price went sideways, turned around in 2016 off the 50 period moving average, bounces off it here, bounces off it there, and then slices through. But look where it turns around from, the 100 period moving average. It goes up, chops around, and where does it turn from? The 100 period moving average again. So now we're coming back to the 50. I'm watching this. If it closes here, that's a buy. If it goes below and goes to the 100 period moving average, that's another buy, and with expectation of it moving up. Final question is going to be this. What if it doesn't turn around and goes against you? Fine. Some trades are going to go in your favor, some are going to go against you. That's where stop losses come in, and that's where you can have protective puts. Okay, so the simple thing to do would be, let's say you buy here and price tanks to here, you buy, and then it goes to the 200 moving average, you buy. If it breaks below that, then you cut the trade. All right. Or what you can do is you buy this, you buy here, and if it goes to this point, then you buy again, but you can buy a protective put. So that way this position is protected. The only exposure you have is on this trade, and it lowers the losses from that moment onwards. What I mean by that is the real loss you're looking at would be on this initial position. This secondary position, because you put in a protective put, will have a much lower loss. And because you're protecting it, it gives you more of an opportunity for price to turn around. So you can either use stop losses, you can use protective puts, or you can just dollar cost average and just sit and wait for it to recover. Okay, but if it doesn't, then you cut the trade. Now, if you've done your work correctly, which is you're choosing quality companies that have been in uptrends, that are moving up, that are big solid companies, then most of your trades should be winners. The only thing you need to be aware of is going to be correlation. So, excuse me. So if we're in a bear market, if you have a lot of correlated trades, then they are going to go against you 100%. So therefore, we need to look at where we are in a market regime. Now, looking at this, if we look at the S&P 500, we can see this is, broadly speaking, quite overextended. So we want to be careful how we trade right now and not have too much exposure, because if this pulls back, when we can see how overextended we are, if this pulls back, it's going to drag a lot of stocks down with it. That's why at this moment in time is the hardest time to trade, because you can have good setups like Microsoft, like T-Mobile, but if the broader market drops, these could get dragged with them. So what I would do at this moment in time, because of how S&P is overextended, is trade light. What I mean by that is I'll be in a position, but if it goes against me, then I'll put a protective put in place automatically. Also, secondly, what I'll do is not have too many positions concurrently and make sure that they're not all too correlated. Okay. Now, in a normal market, what I mean by normal market is if prices are low, S&P 500 comes to the 50 moving average, is close to this, then we can be bolder in our investments and think, right, I can take more positions because it's at a place where I expect a turnaround. All right. So that's a little nuance to have. But the most important thing I want to emphasize is pull up a chart of any security you're looking at, any market. It could be crypto, it could be stocks, it could be indices, futures, and just look at how price firstly goes, whether it's trending. So the first thing you want to look for is a clear trend, higher highs and higher lows, moving up. A second thing you want to look at is the moving averages, the 50, the 100 and 200 all flaring out like this. Okay, that means they're underpinning the move up. The third thing you want to see is price interacting with the moving average. So it's bouncing off it once, twice, three times, and you know, okay, in the future it should bounce off this. Why? Because buyers have turned up before every time it's come into the moving average, and we expect them to turn up again. All right, so we're putting probabilities to get together in our favor to make a wise investment decision. So that's moving averages. Get stuck in, very simple to use. I'm talking about the simple moving average, SMA. There's exponential moving average, which kind of is more sensitive to most recent price action. But I would just say keep it simple with the SMA. Simple moving averages are the most widely used. The 50, the 100, and 200 are the most widely used within the professional investing trading community. So I would stick with those. In terms of time frames, I would stick with monthly, but this can work on any time frame, weekly, daily, whatever. You could also use this for trading on lower time frames. It's basically, I'm giving you a tool you can use. All right. Start with the higher time frame things, monthly, and start with a market, remember, that has an upward trend, or if it's going to be a downward trend, it has a clear trend. That's the most important thing. And secondly, remember, make sure price is interacting cleanly with the moving average, that is bouncing off it, so you have evidence is going to bounce off it in the future. All right. I trust that's been of use to you. I look forward to giving you another video in the future. Until then, take care, enjoy, trade wisely, invest smartly, and I wish you all the best in the current financial market. Take care.